Venture capital is thought of as a risky asset class, and it's true. Investing in one company, it's hard to know the journey that particular one company will take.
So any individual company, the risk of failure is high.
All portfolios really value from being diversified. Venture capital is really an extreme case of that. So that has been historically very, very tricky for people to do in venture capital. You either had a really small portfolio or you had a portfolio that was very local.
So providing them a level of diversification is an important piece of our value proposition.
So we make sure that every fund is diversified by stage, so seed, early growth, sector, so biotech, health tech, consumer, so on and so forth, and then geography. Different sectors of the US, like the Silicon Valley versus New England, but also worldwide.
Most venture firms don't build diversified portfolios because they'll focus on a single sector of expertise that they have.
We have an approach of trying to provide more diversification than what a traditional VC would provide. So we have explicit limits on how much concentration we can have to any one company in a portfolio.
So we're tracking the location of all those deals to make sure that we're not over-indexed in any single entity or location. So approximately our typical fund is going to have between 20 and 30% exposure to seed opportunities, about 50% exposure to early stage opportunities, which is Series A, Series B, and then another 20 to 30% exposure to late stage opportunities. So think Series C and later.
Basic portfolio theory really demonstrates the importance of building a diversified investment portfolio.
So in a given venture portfolio, more than half of the companies are going to fail. And then you're going to have a handful of companies that do pretty well, call it 2 to 5x, and then you have one or two that hit the 10x, 20x, 30x mark, and those are the companies that really return the portfolio.
It's what they call a power law business or a hits business, where a select few in the portfolio really drive returns for the entire asset class.
Anytime you are swinging for the fences, there's certainly risk that is played into that. Disciplined venture investing is important. That means investing serially. It means diversifying your portfolio by vintage year. But the magic of venture capital is that really the few, those very high performing companies with a power law return the whole fund.
Underlying that are really fantastic stories about individual entrepreneurs who have an idea.
These are companies that have visions of being enormous impact to the world. Part of what's exciting about venture capital is that you come in at the ground floor. As an investor at Alumni Ventures, I really appreciate our portfolio approach. And when you take it all together, what that approach does is it very thoughtfully takes advantage of the upside of venture and really optimizes for what the potential return could be.